Hey everyone, I hope you had a good day. Another crazy one in markets. Definitely follow through to the downside. We've been talking about how we were due for a technical bounce, but indeed we were still facing a difficult backdrop. There's just a ton of stock for sale. If you watched my previous video today, I talked a little bit about that. So I did this funny thing with AI. Are you suffering from short gamma? Speak to your doctor. I thought that would be kind of fun to do, and it did a good job. Did a really nice job. It does neon. Just a reminder, everyone, of the disclaimer. So anything we talk about today is for educational, entertainment, and information purposes only. Quite well. So here we are. This is basically where we are. We're in this valley of death. This chart comes from Torsten Slok at Apollo. I've written in the valley of death here, which is a term that we use in back spreads. You're going to get that valley of death in there if you get a little bit too close to expiry. So I've borrowed the term, and this is where we are, and we don't know how long this is going to be. Right? We've got today's economy, tons of debt, massive government spending, all kinds of fluff and waste happening, and so we want to get over here to where we've got a smaller government. Whether that's good or not, I mean, government spending ends up in the private sector, so not sure if that's entirely amazing, but smaller government sector, bigger manufacturing, right? Trump wants to bring back manufacturing, lower imports, and just generally kind of the way that the country used to be a little while ago to kind of recapture some of that the glory that the lower and middle classes had. And I think there's something very interesting about that. So, but the question is how long and what is it going to take to get from A to B, given the pretty severe moves that Trump is making. So here we can see the VIX futures term structure. We're going to look at charts in one moment. VIX term structure, this is kind of showing you that there's very much still in a worried state, right? So here's your VIX up top around 28. Typically an area where markets can bounce a little here. We're going to talk about some things that maybe give us a little bit of fuel for that idea to be bouncing a little bit. But basically, this is very, very nervous. So the vol markets are paying up for that front month, second month, third month, fourth month, typically in a very healthy situation. This is from January. This is very healthy. You've got the VIX down here around 15 and a bit, and you've got this beautifully upward sloping curve, which is very normal, no fear in the front end, and over time they price in higher volatility because anything can happen. But this is a very happy picture. Tends to be a market that's stable and moving upwards. This is not a happy picture. This is everybody panicking. They're rushing into short options, short gamma and protection. And this is where some of these vol products do the opposite of what they typically do 85% of the time, which is the long vol products are going to actually do well in this situation. They've got this positive roll yield, selling something higher, buying it lower, and this gravity is upward pulling towards that VIX. So as we go into expiry next week, I believe, we're going to have this upward gravity pulling these futures up towards the cash, which is making upside VIX flies, which we have in the community, look very interesting, right? So they're structurally very positive. VIX structures can be constructed to be very, very inexpensive relative to what's happening here. Now, can this flip back? Absolutely. So let's take a look at markets. We've got this S&P weekly sitting on that 50-week moving average. We hope that holds. And then we're going to talk about a few stocks of note and indexes of note. So this is our little slide here for this part of the show. Here we go. IWM. Definitely not looking great. It is ultimately, I think it's going to enjoy lower rates. Right now, it's suffering under the weight of course, the growth scare that is not great for anyone or not too many people. Here's your S&P to the consumer staples index. So look at this S&P ratio to the staples coming down as safety has reigned supreme lately. We can see we could probably get down around here. So we have a little bit more ways to go. And so I've been looking at some trades in some of the soft drink makers and Walmart's consumer discretionary, but still almost like a staple in my mind. So, or McDonald's rather. So still some interesting plays in there. Walmart, a staple. So those have been places that people have been hiding a little bit. Here's something for the bulls. The bull bear, the AAII bull bear is starting to get very stretched. Look, we are actually back in near the lows of the 2022 bear market. So extreme bearishness at this point. Now, you can certainly argue that it's for good reason. The world is really, really changing for investors right now with a market that has been priced to perfection and very, very high profit margins. We're going to see some of that unwind. So there's no question that I don't think this is any kind of V recovery in the market. We're going to get huge rallies, rip your face off rallies at some point here. That is normal for bear markets. We saw that in 2022, some massive, massive moves back up, even though most of the year was very difficult. So we're going to get moves both ways, but at the moment, a little bit stretched to the bear side. Here's your 10-year yield bouncing back in the last week or so, and then starting to drift back down towards this 200-day moving average for what that's worth. I don't know if the moving average is worth all that much, but I think if we hold here, probably somewhat positive. If we start to break lower, that's going to be a sign that the growth scare certainly has some validity to it. Here's the 𝐬𝐻, which is to a large extent Microsoft and NVIDIA, and so Microsoft's been weak, not excessively weak. It kind of got its weakness out of the way over the last 6 months, but it has been drifting lower. NVIDIA as well, it's been drifting a little bit lower. I think it get a little lower into the 90s probably for NVIDIA. So I think there could be still just maybe a little bit of downside, but look how far we've come down past that 200-day. We typically don't get too far past the 200-day, so we're definitely in oversold territory in some of these tech names. I think they're starting to overdo it a little bit. Here's your semiconductor index weekly, starting to poke its head below there. We're going to really need, we saw the SMH come off 10 today. We're going to really need this to hold. Otherwise, we could be looking at this 200-day moving average below, which is going to make it very difficult for all the usual suspects that we trade in there. NVIDIA, of course, but the Microns, the AMDs, et cetera, are going to really, really have a tough time. So I'm hoping that we don't get any further follow through and that we recapture this support line and rally our way back to about 4,800, but we've got all these moving averages up here, so we are definitely not out of the woods, even if we do rally about 400 points on the stocks at this point. On the bear side, I hate to say it, if you look at the percent of stocks above the 50-day moving average, still quite high. We tend to bottom out maybe down around between 5 and 20%. We're still kind of 45%. So, it kind of makes sense. I mean, if you look at the longer term chart of S&P, it feels like we've come off, 20%, but we haven't yet. And so there's still a little bit of room to the downside there in terms of an unwind of stocks that have done very, very well. Everyone, this weekend is going to be my enhanced masterclass, 2 days, 1 to 3 o'clock, sometimes even 4 o'clock each day. I'm going to go over my course, but you're going to get all the material right away. It's going to include my Volatility Ninja course. It's going to include my Nomad course, my Condors course. It's going to include all kinds of insight that you're not going to get from anywhere else. So really, and as we can see, as option traders, we are volatility traders. And so we need to understand volatility very well. We need to understand the indicators, the risk gauges. Our risk gauges in the community have been flashing super, super red for a little while now. The MTI went super red on the SPY at 600 on the SPY. So definitely those are things that you're going to want if you're a trader. If not, just buy an index fund because you need to really, really know this stuff. So back to chart, we can see another view of the staples here. Nice breakout, sitting very nicely. A bit of a poked its head up today and pulled its way back. So as long as it's above this trend line, I'd say we're still probably in a little bit of a safety versus growth kind of market until further notice. Here's some of our financials. Very, very big pullback. I picked up some Goldman Sachs today. I think this is probably a very interesting place. I also picked some up last week, a little bit higher, but I think this is somewhere where a relaxation of regulation, we have lower rates, net interest margins should be better. I think we will have deal flow if we don't head into a very severe recession. I don't think it's going to be that bad. So this is where I think JPM, Goldman Sachs, some of these things start to look interesting again. Very high vols in here. Community, we're talking about different ways to express that. BKX, bank index, definitely dropping below that 200-day. Hasn't been there in a very long time. So there's no question the market is not very positive about what was this sort of exuberance after Trump for the financials and the environment that they may be in. definitely has turned, the tables have turned there. But we can see this line, this massive breakout here. If we extend that over, that's pretty much where we are if we extend this blue line across. So that is looking a little bit interesting for a potential bottom. EEM versus SPY. Here's an interesting chart. Very, very poor performance versus the SPY for about 15 years now. So if this is something that maybe we'll keep an eye on, if we start to poke our heads up a little bit higher, this could be something that might develop into something interesting over time. If indeed we're moving cash out of the US and into other areas of the world, as the US, at least temporarily, loses its exceptionalism, there may be money moving into some of these other areas, as we've seen lately into Europe and a few other places. So here's oil. I think XLE, I don't like trading it. It's a little bit too skittish. I don't like trading things that have an underlying commodity that really has a massive influence to them. But we can see that we're getting close to the bottom here. So I'd say you could maybe almost start to look at some vertical sales, credit spreads in XLE and things like that as we sort of recapture here as we get down to that support line. Here is natural gas, just doing awesome, complete opposite of oil, doing very, very well indeed. Bitcoin, that big rounding top there. Again today, very, very difficult day. We made new recent lows down in the 77,000s, I believe. We have maybe a small demand zone in here. And then a little bit stronger demand down between 66 and 72, which was pre-election, right? So we're pretty much getting close to giving up the entire election bump, and that's not great. Now, everybody who thinks that Bitcoin got this from BTS, this is Bitcoin versus 3 times NASDAQ. So as you can see here, you know, a lot of people think Bitcoin kind of has some sort of special allure, and it's against the man, and it's, you know, it's all about fiat currency not being respected and all that stuff. We can see that it's basically just leverage NASDAQ. It's a liquidity vehicle, right? When there's lots of money around, and you know things are going well for growth and speculation, things like that, Bitcoin does well as well. So we'll see if this growth and Momo unwind continues lower. I think it's just going to be difficult for Bitcoin as well, because it's sort of the same thing. I know a lot of people would disagree with me, but at this point, you know, the evidence is fairly clear. Has it done better than stocks over the last 20 years? Of course it has. It's gone from like 50 cents to 80 grand. So, but it really does look like leveraged stocks last little while. Okay, so I hope you enjoyed that, and we'll see you in the next one.